to recoup the input tax that, that you are claiming. Insurance proceeds. Now, under Section 18.4 of the GCT Act, insurance proceeds, it is interpreted that insurance proceeds is subject to the GCT. That's the interpretation, because it mentioned about recoveries, all recoveries and reimbursement of someone, taxable supplies. Those are subject to GCT. But as you might have heard, there's a case in court with DGS, where DGS is challenging the insurance proceeds. What they're saying is that it is not supply, so it is not supposed to be subject to tax. In fact, DGS was obtaining insurance proceeds for things hurricane damage, and the tax office imposed GCT of about $78 million. Now it has gone, it has reached the Court of Appeal now, and I await the outcome very eagerly. Now the typical adjustments that the tax auditor usually do are in two categories when it comes down to input tax. I just mentioned about the adjustments in relation to the supply, and now I'm moving on to the adjustments in relation to the input tax. First of all, under the regulations, input tax, certain input tax has to be restricted. It is restricted. So what you find is that the tax auditors always know that a number of businesses and people, accountants, may not be aware of the fact that certain items, certain GCT should be restricted. So they claim everything. So bear in mind that expenses relating to motor vehicle, private motor vehicle, and when I talk about private motor vehicle, I'm talking like a car and so on. Those GCT on those expenses supposed to be limited to only claiming, you should only claim 50%, basically. Only 50% should be claimed. Also, in regards to services obtained in restaurants, bars, canteen, also services incidental to the provision of entertainment. So one thing, you must know what GCT is restricted, so that you do not claim such GCT on your GCT return. There are also restrictions in regards to the claiming of motor vehicle, the input tax on motor vehicles. There are also some GCT that the regulation stated that you should not claim any GCT on. I mean, you should not claim GCT on certain items. And these include materials used in the construction or repairs of any premises. There's an exclusion in relation to hotels. But normal other businesses, you should not claim any GCT, any input tax on expenses related to refurbishing or whatever repairs that is done. Goods or services supplied to an employee. No GCT is supposed to be claimed. No input tax is supposed to be claimed on those services. Now, when I talk about services provided to employees, we are talking about uniforms, supply of uniforms, that GCT on a uniform that should not be claimed. So we have looked at, let's look at the input tax in relation to exempt supplies. As long as you're in an exempt supply situation, you cannot claim any input tax. If you purchase, if you sell exempt supplies such as like rice and meat, the expense that relates to those items, you cannot claim the input tax on your GCT return. Now, exempt supplies are listed in the GCT Act. It really means that no tax is imposed on those supplies. Now, let's look at GCT. We looked at payroll tax, and we saw the impact that not claiming, not abiding by certain rules according to the Act can cause. Now we're looking at GCT, and we're looking at the impact of interest. So let's look at this. Assume that US Limited was audited by the tax department and was assessed GCT of $1 million. Now this is the impact. $6 million in 5 years and 9 months. Now this interest and penalty is only relating to underpayment. There are other interests and surcharge that can be imposed if you did not file your return and the tax department came in and imposed and make an assessment. There are other surcharge and interests that would be imposed. So $6 million over 5 3/4 years. That is I consider that to be very burdensome for any business. However, please don't overlook your GCT invoices. Don't make sure that you have your GCT invoices. Because when the tax auditors come, they look at your GCT invoice to verify your claim, your input tax claim. So make sure you have your GCT invoice intact. Also, GCT on returns for bad debt. Ensure that you adjust your GCT return for bad debt. So the GCT that you are paid out in regards to output tax, you have to ensure that when you are written it off, the debt off, you claim that GCT on your GCT return. Now basically GCT seems very simple. Many people believe that it is simple, but they still overlook some of the things that I just mentioned. I must tell you that I was conducting a training session, I think about 2 months ago. And after the training session, an accountant came to me and said, you know, I did not know that there were so many issues concerning GCT. All what I thought it was really to compute your output tax and deduct all of your input tax. Now this accountant had 15 years experience, and I can tell you it was a shocker to him. So it is very important that a compliance review that you invest in, a compliance review to ensure that a number of GCT issues can come to the fore. GCT issues, payroll tax issues. Now what I'm going to do, I'm going to move on to the income tax. And I'm going to highlight some of the income tax issues. There are certain typical adjustments for income tax, and these adjustments relate to income and expenditure. By the way, a lot of people just believe that income, that taxable income relate to the major trading income or the sale of inventory. But there are certain income that a business will receive, which would be like it's really sometimes people call it abnormal income or unbudgeted income. But we can call it non-trading receipts. These are subject to tax. Money received in lieu of trading receipts, insurance proceeds for loss of profits, insurance damages, money received for damages for non-performance, and compensation for act of negligence. Now bear in mind also that these proceeds should be excluded from your taxable income. Proceeds from the sale of assets, some received for loss of capital assets, those will be excluded from your taxable income. So what a compliance review will do, a compliance review will identify these items which are sometimes included in total revenue and subject to tax, which will result in an overpayment of your taxes. Now let's look at the expense side. Let's look at the major adjustments relating to expense as it relates to income tax. Now the tax department usually look at two things: revenue versus capital versus revenue, because it is not so easy to identify the difference at times between capital versus revenue. And they also look at expenses disallowed by Section 15 of the Income Tax Act. Section 15 of the Income Tax Act lists a number of expenses that should not be allowed in computing your tax liability. And let's look at capital versus revenue. The impact, that is the impact on your taxes. Capital expenditure, non-deductible for tax purposes, and the revenue expenditure, deductible for tax purposes. But I guess you want to know what is really revenue expenditure and capital expenditure. Now, capital expenditure has certain characteristics, and these characteristics have been established by cases, by tax cases over the years. There is no definition of capital expenditure in the Income Tax Act, and that is why we have to rely on tax cases. Now, the tax cases have come up with three main criteria in determining what is capital expenditure. And the first one is non-recurring. It must be non-recurring. One and for all expenditure, like construction of a drain, construction of a road. Now, it will be revenue if you are maintaining the road. If the expenditure is in relation to maintaining the road or repairing the road. Identifiable asset. Does the capital expenditure result in an identifiable asset? Does it result in a building being constructed, a motor car being built? If it does not, it is more likely not to be capital expenditure. But if it does result in an identifiable asset, it may be considered to be capital expenditure. Now also look at acquisition of another criteria in determining capital expenditure is whether it results in an enduring benefit. An enduring benefit which benefit the business now and in the future. Say, for example, the purchase of certain rights, maybe patent or trademark. So therefore, having looked at the distinction between revenue and capital, we can suggest that construction of a building and equipment that is capital in nature, the acquisition of fixed assets, the improvement of assets, and the acquisition of rights. Now these are what the tax department look for to determine whether you have claimed capital expenditure as a revenue item in your account. And they will certainly make the adjustment. Now there are many, many more adjustments, but let's look at a few of the possible adjustments that the tax auditor may make. Legal and professional fees. If it relates to the purchase of land or building, definitely it to be considered to be disallowed. General provisions, penalties and fees. I know that a number of businesses have claiming fines and penalties in their account. But guess what? The tax department are looking for all of these, and they will definitely adjust for them. Personal and domestic expenses not incurred in earning the income. That is the widest. That is so very wide. What they are saying is that if the expense don't relate to the income that you're earning, it will be disallowed. So if you have another business and you're claiming expenses, for example, salaries in your account, what you'll find is that it will not be allowed because that expense doesn't relate to the business. It has to be wholly and exclusively incurred in earning the income. But don't overlook these. I know many small businesses sometimes overlook with tax withheld and interest. They are reporting the interest, but guess what? They are not claiming the withholding tax as a credit against their tax liability. Contractors levy also ensure that that credit is claimed against your liability, and also ensure that capital gains are not subject to tax in your account. It should not be included in your taxable profits. Now, ladies and gentlemen, I've just completed the tax strategy in regard to compliance. The thing is that a compliance review will definitely be able to identify some of these typical tax audit adjustments that the tax department usually do in order to increase your liability. So unless you're going to do it, go through your accounts, and I know that many persons are very busy. Many accountants are so busy. I see that you may be thinking of budgets and all of those things that Mario spoke about, and you may not be in tune with the regulation and the tax. So sometimes you may need professional help in that regard. Okay? Now, tax planning. My next topic is tax planning. This is another tax strategy for minimizing your tax liability. I just looked at compliance to ensure that that all the interest and penalty is not imposed on liabilities, imposed on adjustments made by the tax auditors. So let's look at tax planning. The areas that I will cover will include the meaning of tax planning. What's the meaning of tax planning? The prerequisite for effective tax planning, general tax planning strategies, specific planning issues as they relate to employees, independent contractors, and businesses. And last of all, I'll be looking at the anti-avoidance provisions. Now, tax planning can be defined as follows. There are many definitions of tax planning. But it can be defined as an exercise undertaken to minimize tax liability through the best use of the available allowance, deductions, exclusions, and exemptions. Now, what is acceptable tax planning? When we talk about tax planning, we're talking about minimizing tax. That is exactly what tax planning aims to do. Now, in the case of the Inland Revenue Commissioner versus the Duke of Westminster, Lord Tomlin stated, every man is entitled, if he can, to order his affairs so that the tax attaching under the appropriate acts is less than it otherwise should be. That's a major case. That's a major case involving some anti-avoidance matters. Now, what is tax planning? Is it tax avoidance or tax evasion? It's certainly not tax avoidance. Evasion. Because tax evasion is considered to be illegal and unacceptable. Tax evasion means that you're possibly over-reporting your expenses and under-reporting your income. It's therefore not. But based on this case, we are at liberty to arrange our affairs so that they pay less tax. Not suggesting that you indulge in tax evasion. Tax avoidance, I put those 3 marks because some people believe that it is wrong, some people have different views on it. So I won't touch that. That is very much debatable. Now, if you are engaged in tax planning, there are certain prerequisites. You have to have knowledge of the tax laws and the regulations. You definitely have to know about the treaties, especially if you are involved in cross-border transactions. You have to know all the regulations and taxes and tax laws relating to the industry that you are in order to ensure that we know exactly what tax is imposed on particular transaction, to ensure that we are aware of all incentives, exemptions, and credits that are available. One thing I can tell you, there are many credits and relief and exemptions that are out there, but guess what? People are not aware of these tax strategies that can minimize the tax liability. Ensure we are familiar with the anti-avoidance provisions. You don't want to establish tax planning structure and then the anti-avoidance provision make it null and void. Another prerequisite for effective tax planning is avoidance of interest and penalties. That's the first thing, and that is why we looked at it earlier in the presentation. Review the impact of plans on all forms of taxation. When you are engaged in tax planning efforts, you have to do this. You have to review the impact of plans on all forms of taxation. It may be GCT, it may be income tax. Don't jump from the income tax file one into the GCT file. One thing that GCT does, it tries to capture every activity. And you may be engaged in some significant tax arrangement. And guess what? At the end of the day, there's GCT liability that you have to put up with. So it's very important that a proper review is done. There are different types of tax strategies. Many of these strategies are aimed at obtaining tax deductions, obtaining tax set-off and relief, allowing an entity or person with a low tax rate or zero tax rate to generate income, rather than an entity paying higher rate of tax. Also, defer income or expense to another period where there is a lower tax rate. Those are some of the strategies. However, these are not, you have many more strategies related to tax planning. Now, let's adjust this. Let's address tax planning strategies as they relate to personal and payroll, and also independent contractors. Many of us may believe that, I'm on the payroll, there's no tax strategy that I can implement. But that is wrong. So I'm going to look at few. By the way, anyone can tell me any tax planning device as it relates to employee, apart from what I want to work. Huh? Anyone?
Pension.
Pension. Exactly. Exactly. What was that? Are you entitled to go to the basket?
Yes.
No.
Exactly. I didn't put it up here. Alright. Now, payroll persons on the payroll, right? They can benefit from the provision of a fully maintained motor vehicle. Now, instead of, okay, let me tell you, when an employee gets a fully maintained motor vehicle, the maximum benefit that is assessed and taxed is $140,000. That is the maximum. And the tax itself is only $35,000 for the year. Well, guess what? If you have your own motor vehicle, gas per week is about what? $6,000? Huh? How much is it? Only $20,000. Okay? For the week. Well, my gas is about $6,000 for the week, so I'm just using it as a benchmark. But I'll assume $6,000 for the week. Now, when I multiply $6,000 by 52, how much do you get? About $312,000. Okay. And that is only gas. Let's look at insurance. Your insurance might be about $100,000. That's $412,000. I'm not talking about repairs and all of that. But when you get a fully maintained motor vehicle, the amount of tax that you pay is only $35,000. So that's a big benefit that an employee can get. Traveling allowance. Let's look at traveling allowance. As long as you're in a traveling position, you're entitled to get a traveling allowance. You can get part of your salary or a traveling allowance tax-free. The thing is that there will be no tax on it, so therefore you'll be able to save tax. But not only you, the employer will be able to save, because the employer does not have to pay employers' contributions on such payment. If it was a different payment now, definitely you would have employers' contribution. So there are benefits, and also the pension that you mentioned. There are independent retirement schemes that are available, and you can save up to 20% of your salary income. I know that you may have some persons who are independent contractors here. Up to 20%, tax-free. Tax-free. So if it is, say, for example, $1 million, then that is your salary, $1 million. You can save up to $400,000 tax-free. To not be, and they also can be, they can also be more aggressive in claiming the expenses. So while a PAY person, a person on the PAY system is subject to tax upfront and the payment is made every month. Not independent contractor pay that tax at the end of the year, but he's also able to claim certain expenses, possibly accommodation, if that involves doing his job, and other expenses, secretarial expenses, and so on. Now, for both employees and contractors, both employees and independent contractors, if they have businesses, that possibly may be making a loss, they can offset that loss against their other income, whether employment income or independent contract income. So there's a big benefit there. You file your income tax return, you report the business that is making a loss, you report the activity of that business that is making a loss, and you possibly can claim tax refund. Now let's also, in terms of Section 50 of the Income Tax Act, and many people may not be aware of this, that a wife can allow her husband to file her activity on his income tax return, in her business activity. Now, this is beneficial if that spouse business is making a loss, and above the threshold also. Now let's look at business profits. And in looking at business profits, I'll be looking at companies and partnership. Now the first consideration when we're looking at the business profits is the structure of the organization, of the business. If it is a company, you can look there. Companies, you have to look at the fact that companies generate two tiers of tax, that is corporation tax, along with dividend, and you have transfer tax, when there's any share transfers. For partnership, you have transfer of, there's no transfer tax on the transfer of interest, and partners usually report their share of profit. And in reporting their share of profit, they are able to claim the threshold. So right out the window, they can reduce their tax. They can reduce their tax by, how much is it? It's going to be 500,000 next year. Threshold will be 500,000 next year. So these are the things that you have to look at. Whether you're going to form a company, or whether you're going to be in a partnership situation. There are benefits on both sides. Now I know that a lot of companies, a lot of persons are from different businesses that have different structures and all of that. So what I'm going to do, I'm going to look at this checklist. I'm going to go through this checklist. This checklist have different points of tax for tax planning. It may not suit your company or business, but it may suit others. if you're in a group of companies, you need to find out whether the company operates, the company operation is structured so that there is utilization of losses. There could be services that are rendered, and therefore there's a possibility of offsetting profits. You need to know the maximum capital allowance rates. You need to look at the available incentives. There are a number of incentives outside here. Talking about the Urban Relief Act. I mean, when I read that act, there are a lot of incentives there for businesses. Income from CARICOM. You need to understand, you need to know whether if you invest in CARICOM activity, in CARICOM companies, whether you can benefit from lower tax rates. Consider evaluating the benefits of establishing a company in CARICOM, a holding company in CARICOM. There's a possibility that you can get significant benefits there. Evaluate the benefits of leasing versus outright purchase. For leasing, you're able to claim all the GC, you're able to claim all the costs of it, all the costs of the lease. But I'll have to explain that further. But I know I'm running out of time. Now, general provisions. Also, general provisions. What you need to do is to convert general provision into specific provision, because general provisions are not allowed by the Income Tax Act, but the revenue will allow specific provisions. For GCT, you need to know the source of non-traded income. Also for GCT, in terms of the apportionment of mixed exempt supply to taxable supply, you need to be able to use an appropriate apportionment that can benefit you. The GCT Act allows reasonable apportionment. I know that many people just look at the fact, just apportion based on sales, but it doesn't have to be like that. Intercompany transaction may also be structured to reduce GCT. Now consider listing on the stock exchange, the junior stock exchange. You have 5 years tax-free. 5 years, and even more. If you are conducting a reorganization effort, there is tax benefit that you can gain under the Transfer Tax Act. Now, finally, I'm going to look at anti-avoidance. With all the structures that we have mentioned, with all the possible tax planning opportunities that we have mentioned, we have to be cognizant of certain provisions that are in the Income Tax Act. And the main provision is Section 16, sorry. It said where the Commission is of the opinion that any transaction which reduces or would reduce the amount of tax payable by any person is artificial or fictitious, or that the full effect has not in fact been given to any disposition, the Commissioner may disregard such transaction or disposition. Section 17.1 allows the Commissioner to disregard non-arm's length transaction. So if you're doing transaction between related parties, you have to be careful. Section 17.2 empowers the Commissioner to substitute arm's length consideration for non-arm's length. Basically what it is saying is that if you have if you did a transaction, but it is not one that would be on the if it is not equivalent to the open market transaction, the Commissioner can disregard it. And you can read the other provisions, Section 18 of the income tax, 19 there. And for your benefit, I've listed the various tax types. I know that they might have many more tax types. But I've listed a few showing the date, tax rate, penalties, and all of that. Now, ladies and gentlemen, I want to thank you for bearing with me. You have seen that there is significant possibility of minimizing your tax liability. There's significant possibility, starting off with a compliance review, which will ensure that you treat transactions appropriately, and also looking at tax planning, which will definitely allow you to utilize available credits, available allowances for your benefit. And I should tell you, if you need any assistance in this regard, just a telephone call away. All right, thank you very much, and I will leave. Good afternoon.